Hello everyone, welcome to Accounting 210. In this video, we will talk about Chapter 10, Performance Evaluation. Um, there are two main important parts in this chapter, and Chapter 10 and Chapter 11, they are connected, related. So what I want to first point out is um, if you feel, hey, I don't really get this chapter after watching the video, don't worry too much because we will talk about the detail in chapter 11. But after doing chapter 11, you still have some concern, and then you email me then after we finish chapter 11. Okay, so let's get started. Okay, let's get started. Performance evaluation, from the name, what you will expect for this chapter. So how do you evaluate the performance of the managers, right? As students, you may be evaluated by exam, quiz, homework. For the managers, they will also be evaluated. So first page, I kind of give you some concept. I'm not going to really read too much. If you have learned, management or marketing or whatever, basically, if you're a business school, you should get some idea called decentralization. So you don't centralize the power, right? You decentralize to each department or to the channel, to the division. So what I'm doing is I have my textbook here also. I put the page that you want to look at it. Decentralization, this is on page 800, 584. So you can say, make sure you put when you read textbook, you write down the concept, advantage and disadvantage as everything. It always has two sides, right? It has good part, it has not that good part. So make sure you read your textbook, get some general idea. The only reason I ask you to read textbook is when you have a multiple choice, you can get the right answer. Okay? I will never ask you to write the sentence word by word. So as long as you understand concept, cool. Next one, what is responsibility accounting? So this is kind of, I think it's a good concept. So let's go to page 585. I'm not really going to read, but you can see it here. Sorry, I go from here. A responsibility center, right? So it's responsible for something. It's responsible for something. You have different levels of the center, different types of the center. So cost center. Okay, I want to go through this with you. Cost center. What's the meaning of a cost center? They are only responsible, or they will be mainly evaluated by their cost. What's the meaning, right? What's the meaning? Managers are accountable for costs only. Why? You thought, hey, managers, they generate revenue. We should always look at the operating income. So why they are only responsible for cost, not the operating income? Because some department, like a manufacturing department, let's say, they don't really sell things. So how can they have revenue? All they can do is to control the cost, right? So if their cost is lower, then that's all. They will not have income, so they will not have revenue. So they will be evaluated by the cost. That's the reason they are called as a cost center. Like our accountant, we don't go around to sell products. So all we can do is we control the cost, right? Like we don't waste the paper, we don't waste the ink, we control for the cost. So that's the meaning of a cost center. The center is evaluated by its cost. So hopefully you will feel better. So next one, revenue center. Revenue center. So it's only responsible for the revenue. They said most of the time, revenue center are sales territories, such as geographical area within the country, right? So they are only focused on the revenue. But next one is more common, profit center. That's just what you want to think, right? It's responsible for revenue and it's also responsible for the cost. So they will be evaluated based on the profit. They will be responsible for their profit. Last one is investment center. Investment center is a higher level, it also has a revenue, it also has a cost, and then they also want to invest the assets. So like bigger divisions, the upper level, they have a right to invest. So invest center is not just the investment center is the cost, the revenue, the profit, and also the invest. Okay, I think that's all I want to go through with you for the textbook part. And then next one, develop a performance report. So I even put the textbook here is basically page 588 to 587, 89. So we review this kind of briefly. There are two important concepts that you want to know, okay? As I say, these two, they are related with chapter 11. So don't cry if you say, oh, I don't really know, don't cry. But get some general idea now. I believe you all know this word, right, called variance. So what's the meaning of variance in our accounting class, especially we talk about evaluation? Variance is the difference between actual and the budgeted number. So variance is the difference. So variance is the difference of your actual and your budget. So what's the meaning? Think about this. Hey, you thought you will get 80 points in this class. So your budgeted is 80, right? But you got 85. So what's the variance? The variance is 5, and you are doing better than your budget. So what should we say in accounting? You will have favorable variance. You will have favorable variance, okay? You will have favorable variance when your actual is better than the budget. On the other side, you thought you will get 90, but you only got 87. Let's just say you only got 87. What first is, what's the variance? The variance is 3. So are you doing better than the budget? Not really this time, right? So what should we call? Unfavorable variance. Okay, so we want to talk professionally, right? We want to separate ourselves from students who never learned accounting 210. Instead of saying, hey, difference, good, bad, we call favorable, unfavorable variance. Something I want to point out here, it will help you in next chapter. So when we talk about variance, we always put our actual on the left side, and we put our budget on the right side. It's easy to remember because the way I do it is the A, right? Actual A always goes before B. So you put A first, you put B second. So actual is always on the left side. Budget is always on the right side. And how do we decide favorable or unfavorable? Generally speaking, if you are better off, your actual is better off, then it's favorable. If your actual is worse, so it's unfavorable. It doesn't mean larger number, it doesn't mean larger number actual is better. Okay, so you say, what does it mean? What does that mean, right? So if it's your points, definitely larger number means favorable for actual. So similarly with your revenue, you thought you will sell $80, but you sold $85. Yes, your actual is $5 more, so it's a $5 favorable. But if we look at the cost, okay? So if we look at the cost, You thought you will only cost $80, but you cost $85. 85 is larger than 80, right? Are you better off? No, because it's the cost. In that situation, you will have a $5 unfavorable. You will have a $5 unfavorable. So don't memorize it. It's really very natural. So ask yourself, does it help you? You are better or you are worse? That's it. Okay, you are better or you are worse. Okay, so remember those things. What's the meaning of variance? We put actual left, we put budget right, and then how do we decide the favorable, unfavorable? Segment margin, don't really worry too much, but if you have any, question, active duty or my accounting lab, just to make sure segment margin is we don't allocate some division cost to that segment. So some people say, hey, the general R&D is not my business, so why my segment has to be accounted for that one? So segment margin is the operating income generated by profit or investment center before subtracting some common fixed cost. So that's some idea, as I always say, just for multiple choice. Next one. So this is the first main part of chapter 10, evaluation of investment center. So as you say, investment center, they will be evaluated for the revenue, for the cost, for the profit, and also for the investment. So how do we measure them? In this chapter, I think we learn some ratios, right? Always it's easier to get some ratios. So you have these two divisions, and then operating income, assets, sales, and revenue. The first one, we measure them based on ROI, right? Sounds very professional, right? ROI, very professional. So what's the meaning of ROI? Return on investment, return on investment. So whenever, most likely, I cannot say whenever, but most likely when you say something on something, the on means divide. The on means divide. So you can see the formula ROI equals return divided by investment. Return divided by investment. I'm not going to say too much. Let's get the numbers since we are already putting there. ROI, let's say for the first Pepsi, return is your income. Return is your income. So it will be 2785. Investment will be my total assets, 28,128. Free total will be 43045,375. Let me double check. I'm not really sure with myself. Okay, so you get the number is 9.9%. This one is 80.1%. Larger number means better. Larger number means that better. So we said, in this situation, free total is better, has a higher return. Okay. You guys said, how did you get the number? We said ROI is a return on investment. What's the meaning of a return? What's the meaning of a return? It's the money you will get, right? So the return in this chapter is your operating income. What's the meaning of investment? In this chapter is your total assets. It's your total assets. Measures the amount of income an investment center earns relative to the size of its assets. So basically, given the same assets, how much operating income the division will generate. So for the Pepsi operating income, so we look at this column and this column. Operating income divided by assets, operating income divided by assets for the free total. So this is how you get the number return on investment, ROI, return on investment. You have two requirements you need to know. First is how do you calculate? If I test you, I would say you definitely have a question in the exam or in the my accounting lab. So how do you get the numbers? Return on investment, operating income divided by total assets. And how do you interpret? That means you kind of invest 5,375. you will generate 80% as the income, as the return. We want the number to be larger or smaller. I want to hear your answer. I hope you are saying larger is better. Perfect, right? Larger is better. That means given the same amount of asset, you can generate more return, which is more income. Okay. So this we are done for the first one. Oh my goodness, we are so great. Next one, sales margin and capital turnover. So sales margin, we go each one, right? Sales margin, what's the meaning of sales margin? It's profitability by showing how much operating income the division earn on every $1 of sales revenue. So sales margin is your operating income divided by sales, sales margin. So it's a sales for $1 you sell, what's the margin going to your profitability, going to your income. So let's do the numbers, okay? So for the first division, we look at operating income divided by sales revenue. So it will be 2785 2618. Everybody knows how I got those two numbers. For the second division will be 4304 divided by 14782. So if you get the number, I believe will be 13.5%, and then also 29.1%, also 29.1%. So this is the sales margin. What's the meaning? For Pepsi, for $1 they sell, they will have 13.5 cents going into their income as the profitability. For Frito, for every $1 they sell, they will have a 29 cents, almost 30 cents going into their income as the profit. So we said the higher number is better, right? So higher number is better. Next one, talking about capital turnover. Capital turnover, it measures how efficiently the division uses its assets to generate sales revenue. What's the meaning? How do you use your assets to generate sales revenue? So how do we get the number? Is your sales revenue divided by your assets, How of your assets generate your sales revenue? So we do the numbers for the first one. For the Pepsi, it will be sales divided by assets. 2618, 28,128. Next one, 14,782, 5375. Okay, so I got 0.73, I got 2.75. What does that mean? It means for $1 you invested as the assets, Pepsi will have 73 cents to increased revenue. For the Frito, for $1 you invest as the assets, let's say you buy a new machine, then the $1 extra in the asset will increase the revenue by $2.75. Wow, that's kind of sounds a big number, right? That's really big number. So we still say larger number is better. So you have those three things on this page. Make sure you get the idea, make sure you know their formula and practice some. ROI, I think is easy to memorize, return on investment. Sales margin is kind of okay, so it's the margin on your sales. So margin is your income divided by sale. Capital turnover, that means your capital is just your assets. Turnover is your sales. So how much your asset will generate for the sales, for the revenue. Okay, I still have one last part. Then we are done. Okay, give me 5 more minutes. Give me 3 more minutes. Let's finish this one. Sorry, I don't want to make a long video, but let's finish this one. RR is called residual income. Before we talk about this fancy accounting thing, let me ask you a question. At the beginning of the year, you borrowed $100 from the bank, right? But bank will not give you money for free. what they will do, they will say, hey, I need to have interest. I need to have interest as 10%. Okay, I need to have interest as 10%. At the end of the year, you use the bank money, you know, you invested, you do this, and then at the end of the year, you got your cash, you got your money. I make a number. Let's say you got $120. You get $120. My question: do you claim all of this 120 to yourself? Do you? Yes or no? No, right? You cannot do that. You cannot say, hey, all of this 120 goes to my pocket. No, not all of 120 goes to your pocket. So how much money really goes to your pocket? You answer me this question. How much really goes to your pocket? You will say, I need to return the 100 to bank, so I still have $20. Is that right? No, because bank doesn't just want 100 back. Bank also want to get its interest. So what really has to be paid for? Out of this 120, you have to return the bank the principal, and then also the interest, right? Which is $10 is your principal times the interest, the return the bank required. So what really belongs to you will be 120 minus 100 plus 10 will be 120 minus 110 will be $10. How do we call this in our fancy accounting? We call it as residual income. Does this make sense? Ta-da, right? It's your income, but it's the residual. What's the meaning of residual? The money left for you after you pay the principal and the interest. Yeah, that's the residual income. That's the ROI. You got it. So you have two things. So we said you have to have the target of return. In our example, it's just this 10%. The minimum accepted rate of return that top management expects a division to earn with its assets. And then ROI is whether the division has created any excess or residual income above and beyond the expectation. It compares actual operating income with the minimum operating income that top manager expects given the size of division's assets, right? So blah, 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 blah. What's that mean? Someone invested you 100 and ask a return to be 10%, right? Your minimum you have to generate is 110 because that's the assets, that's the return. Do you really go above it? Yes, you generated more than 110, so you will have a positive residual as $10. Give me one more minute. I'll do this one with you, and then we are done for the first part. We are done for the first part. So we have to think about those two divisions, right? How do we get numbers? I put the formula kind of residual income is the company's income minus the investment, and also the return, right? Minus the investment and then also the return. So for your first division, we said the investment is asset. You invested this much, and the return we require to be 25%. We require the return to be 25%. Okay. What do I want to say? Oh, for this part, they only require you generate more money than the return. They don't ask to get your principal back. But in my example, I ask you to return the $100 to the bank because maybe it's just a 1-year contract. But in our example, you just need to generate enough money to cover the return. So we just use the investment time return. We don't worry about the principal. My bad, but so let's just do this one. Pepsi, so your income, Pepsi said that the operating income is, I hope you still remember the number, 2,785. So 2,785, we minus the investment. We said the investment is the asset. 128 times the return will require, the question will tell you we require the return to be 25%. And then if you do the math, you will find out, oh my goodness, it's a negative number. It's a negative number. For the Frito, it's the same. Your income is 4,304. So 4,304 minus investment, which is your asset, 5,375, 5,375 times 25%. So you will have a residual of $29,060. You tell me which division is doing better. Ta-da! It's our Frito, right? So the income is more than required return. But for Pepsi, it doesn't even cover the required return. So you will have a negative residual. You will have a negative residual. So this is how you get the residual income. So I'm sorry if I confused you. I'm sorry you don't really need to worry about the principle in the textbook example. So all you need to do is you just return the interest to the bank. Okay, I change my example to be consistent with the textbook. So go with the textbook definition. Your residual income is your income after paying the required return. That's it. It's your income minus your investment time the required return. So if it's negative, that means you are not doing good. They want to get some money, but you didn't even cover the required return. But if it's a positive number, you are doing better, you are doing good, right? You got more than the required part, so you have some positive residual income. Okay, we practice some questions together, and then hopefully you feel better after we play with the numbers. Thank you. I'll see you next time.